Hello, I'm Jack of all trades, and today I want to talk with you about the PE ratio. The PE ratio is used by a lot of investors to determine if a stock is overvalued or undervalued. The PE ratio is not the holy grail though. You should look at it, but also look at other factors. And today I made a presentation to show you what you should look at when looking at the PE ratio. Let's have a look together. So today first we will look into what is the PE ratio. Then we'll look at an example of 4 different companies, A, B, C, and D. Then we'll look at a real example of Microsoft. And then we'll finish up with several slides showing that growth is the key for PE ratio. It's good to know I'm not a financial advisor. Everything I share is my personal opinion. So if you want to buy stocks or sell stocks, do your own research. I'm just sharing my knowledge. What is the PE ratio? Well, the PE ratio is the price of a stock divided by the earnings of a stock. If you have a high PE ratio, it means that you're paying a lot to get the current earnings. If you have a low PE ratio, then it means that you're paying very little for the current earnings. The word current is very important because, as we'll see later, that growth is a very important factor that will influence your PE ratio. The average PE ratio is 15, but this changes over time, but around 15 is what is normal to look at. So let's dive into 4 different companies. They all have the same share price of $1,500. And company A has 100 earnings, but is not growing. Company B has $50 earnings and has a 10% growth. Company C has 50% earnings and 50% growth. And company D has 200 earnings, but has a negative growth. Let's first look at company A, the baseline. So as I said earlier, the share price is $1,500. The current earnings is $100. They're not growing, so the earnings will stay the same. So the PE ratio is stable. So if you divide them, the 1,500 share price by the 100 earnings, you will have a PE ratio of 15 that stays the same every year for the upcoming 10 years. Let's look at company B. Company B has a little growth, but started with a lower earnings. So the share price again is $1,500. The earnings is $50, which means if you divide the $1,500 by $50 earnings, you get a PE ratio of 30. It has a 10% growth, but because of that growth, you will see that the PE ratio will drop over several years. So it starts with 30, but after 10 years, it's close to 11. And the tipping point compared to the baseline company A is between 7 and 8 years. Company C is a more exaggerated version of company B. The earnings right now is $50 with the same share price that we saw on the previous companies, which is $1,500. So they will start off with a PE ratio of 30. But the growth in this company is 50%, meaning every year the growth of the earnings will be 50% higher. Because of this, the PE ratio will drop even more quickly than at company B. As you can see, at the end of the 10 years, the PE ratio is 0.52, which is extremely low. And already in year 2, you are getting below the 15 PE ratio that we had at company A. So as you can see, the influence of growth is extremely important. Company D is a different situation. It's a company that has negative growth. The share price is also $1,500, but the earnings is $200, meaning that it starts off with a PE ratio of 7.5. But because of the negative growth, the earnings are declining each year. The PE ratio therefore goes up over time. And between year 6 and 7, you're already at the tipping point that the PE ratio is above 15. So you can see the opposite effect of growth. If it's negative, then any PE ratio that you have will eventually go up if the share price stays the same. So let's look at a real example of Microsoft. And to be able to do that, I will show you the stock analyzer that I made. Here it still shows Baba, which Alibaba I had a video about a couple days ago, showing what I think of the company. But today we're looking at Microsoft. So I will change the Baba into MSFT. It will update into the information that we need. And when I get here to the income statement yearly, I will get all the information that's necessary over here. And I want to look at the earnings per share. When I look at the ratios yearly, I will get the same information that I need. I get the PE ratios here. I already made an Excel sheet with this information, so let's dive into that. That's the next tab. That's this one. And here you can see from Microsoft from 2023 until 2014, back in time, what their PE ratio was and what their earnings per share was. And on row 5, I added the average share price because this is a yearly number. So this is with a formula. So I looked at year 2015 because the PE ratio was very high there. And I calculated what the share price would have been, which is 43.35. And for the upcoming years, as you can see over here, I looked at J5, that's this price, and I divided it by I3, which is the earnings per share at that moment. And here you can see how every year J5 stays the same, but we're moving up with the years with the current earnings per share, what the PE ratio would have been. So when you have started in 2015 with a PE ratio of 29, you would have ended up with a PE ratio of 4.48 based on what you paid for it in 2015. This shows that even though you can pay a high PE ratio, if the growth is there, it will eventually be a good investment. So let's get back to the slides and to the next one. As I said, growth is key. The future growth determines if a PE ratio is justified or not. A ratio that looks at this is the price to earnings to growth ratio, the PEG. From the companies we saw before, on the right top, I made a small calculation to show what it would have been. So company A had no growth, so yeah, you can't divide by 0, so it has no PEG. But company B had a PE ratio of 30 and a growth of 10%, so the PEG would have been 3. But company C, with the same PE ratio, had a growth of 50%. So the PEG ratio would have been 0.6. And company D had negative growth, so PEG doesn't apply there. So a lower PEG is better because then there is more growth than price to earnings. And as we saw from the different companies over here, company C is actually doing really well. A lower PEG means that the company is doing well and it might be undervalued at the moment. If the PEG is high, then it might be overvalued, so you might not want to pay as much for it. There's one more thing I want to share with you, and that's the relation between the PE ratio, growth, and time. Because when companies can grow infinitely, and you have enough time, then any PEs or any price that you pay for the current earnings can work. Because the earnings, they will keep rising, and the share will grow into the high PE each year. For example, if you have company E that has $50 earnings and a 30 PE, and it will only grow 1% each year. In 70 years, you will have a PE ratio of 15, and that will keep going on forever. So it is important to know the value of growth. So if the growth doesn't stop, then almost any price will do. But it's very difficult to predict the future growth of a company. So that's where investing becomes more difficult. It's very important to look at the quality of a company. If the quality is good, they will probably have more growth in the future, and therefore you might be willing to pay a higher PE than you would for a company that is not growing anymore. So it's important to relate your PE to growth. Well, I hope this gave you some insight. If you want to help me out, please subscribe to my channel, like this video, and comment if you have any questions. Thanks for watching, and I hope to see you next time. See you.